Today is Monday, May 13th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, and Alan Bush, ADMIS Senior Financial Economist. Started with the grain markets this morning, Mark. We had a USDA report on Friday. Any big surprises?
There's two things really jump out to me. First off, in corn, the USDA was pretty aggressive at raising U.S. demand relative to expectations, and in doing so, only with modest decreases to South American production. For both old and new crop, demand was raised 100 million bushels, with exports and usage for ethanol raised 50 million each. For the new crop, these were increases over the figures by the USDA in the February Outlook Conference. Ending stocks at just over 2.2 billion on old, 2.1 billion on new crop. Yeah, by no means tight, however, at the very low end of expectations, and do provide less cushion if we do experience below trend line yields this growing season here in the U.S. The USDA already has record yields of 181 bushels an acre plugged in. Meanwhile, the USA only lowered Argentine and Brazilian production 2 million metric tons each, and they remain well above most estimates coming out of South America. CONAB comes out tomorrow with their updated production forecast for Brazil, and I think will likely widen the gap between the USDA estimates in April. So if the USDA is forced to lower their estimates down the road, we're likely to see even higher usage figures here, or demand figures here for U.S. corn. And secondly, was a very low soft red winter wheat production forecast at only 344 million bushels. That was down 105 from a year ago and 60 million below expectations. So couple this with declining production forecasts coming from Russia. That's why wheat prices here have surged to 9-month highs, with Chicago closing in on the $7 price level.
Mark, there's been some change with regard to the current speculative positions in the market. Can you give us a rundown there?
Yeah, money managers and index funds were both really big buyers in the ag space last week. Money managers bought just over 250,000 contracts between the grains and the livestock, while in the index funds, they added 59,000 contracts. Money managers, they're still net short in the ag space. However, their smallest net short position since last November. Index funds, their holdings now have swelled to their highest levels since September of 2022, and they're up 31% from their cyclical low here in December. While the speculative traders were busy buying, farmers in both North America and South America were busy selling. The producer merchant short in corn jumped over 107,000 contracts last week, and that's the most since May of 2017. In beans, it jumped 85,000 contracts, and that was the most since August of 2020.
Mark, last question. What are your expectations for this afternoon's crop progress and condition report?
Well, I think planting progress was slowed a little bit here in the eastern corn belt this past week, but good progress likely made in the west. I see corn plantings reaching nearly 50%, still slightly below a year ago and the 5-year average. I see bean plantings at just over 40%. That's ahead of the 5-year average, however, below the year ago pace. Spring wheat plantings, I got them at nearly 2/3 complete, well above the historical average. And I see winter wheat crop conditions improving about 1, maybe 2%, back up to 51% good to excellent. And it's well above a year ago, historically about average.
Thanks, Mark. Turning toward the financial markets, Alan, easy question. When will the Fed Reserve start lowering interest rates?
Well, there is growing evidence that the higher for longer mantra is coming to an end. So I think gone are the days when financial futures markets are predicting that the Fed will pivot to accommodation at a more distant meeting. So right now, financial futures markets are predicting that there is a very good chance, much better than a 50% chance that the Fed will be cutting by 25 basis points at the September 18th meeting. In fact, there's about a 63% chance of just that. And this is not just the case for the Federal Reserve, but also for the European Central Bank, which may lower its key rate in June. And in fact, several ECB officials basically said that they are cutting in June. And I think the Bank of England probably will be cutting sooner rather than later. There's a small chance that they could cut at the June 20th meeting. and a more likely chance of an August 1st cut. So I'm of the belief that we will be seeing central banks cutting rates, and I do not think they will be extended as far as when they'll be cutting in their time frame. So June for the ECB, and I think in September, I think is a very good date for when the Fed will be cutting by 25 basis points.
And looking at the yield curve, will futures at the long end of the yield curve continue to gain on futures at the short end of the curve?
Yes, they will. In fact, the fundamentals and technicals have improved for futures across the board, especially at the mid to long end of the curve. One new fundamental that has supported futures farther down the yield curve is the Fed announcing its intention to reduce the pace of its quantitative tightening starting from June 1st. So an adjustment involving the cutting of the maximum amount of treasury securities being removed from the balance sheet by over 50%, which would take it down to 25 billion monthly from 60 billion, is a very significant move and a change in policy. So this reduced roll-off of the Fed's balance sheet is a de facto accommodation, most beneficial to mid-curve futures and long end of the curve futures.
Lastly, what economic reports have the most potentially market-moving impact this week for financial futures markets?
Okay, Tuesday, we'll have the April Producer Price Index. That's guessed at up 0.3%. Wednesday, the April Consumer Price Index, also guessed at up 0.3%. And then finally on Friday, the April Leading Indicators, and that is predicted to be down 0.3%.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.